Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil slumping after a report that Israel will avoid targeting Iran's crude infrastructure and instead focus on the military. It is easing concerns of a major supply disruption. China looks to raise around $850 billion in special bonds and by taxing the ultra-rich to boost the economy. Former president of Senegal, Macky Sall, tells Bloomberg exclusively he hopes the next U.S. president will be more open to the needs of Africa. Plus, the state of UK politics and the economy. We'll hear from our exclusive interview with Prime Minister Keir Starmer, followed by a conversation with former Chancellor Nadhim Zahawi. Well, it has just gone 8 a.m. across the Emirates. I'm Jumana Versace in Dubai. Let's get you caught up on these markets because once again, we saw another record high for the S&P. It's 46th record high for the year. And as we look ahead to earnings season, of course, remember that we had a very strong start with some of the banks reporting last Friday. JP Morgan, Wells Fargo, very strong in terms of the outlook and also in terms of beats versus market expectation. That sort of sets the stage for the next round of banks that are reporting today, including Goldman Sachs and Bank of America and Citigroup also reporting. All of those three will be reporting later today. So that sort of sets the stage for the earnings season. But then we have seen some positive momentum back in tech stocks again. NVIDIA once more making a record high. So even though we had that brief dip a month ago, NVIDIA now back to record highs once more. The Nasdaq this morning leaning towards the green after a positive close yesterday. But all eyes on the energy complex. As you can see, Brent is back down to a $75 handle, down 3%. A lot of factors contributing, but namely one of the main geopolitical stories is a report that came out, we're going to speak about that shortly, suggesting that Israel's reprisal to Iran will be focused on military infrastructure as opposed to oil infrastructure. The energy market breathing a sigh of relief, as you can see this morning. And then Asia-Pacific in focus once more. The handover from overnight has been pretty positive, up 0.4%. A quick look, I just wanted to flag one of our terminal charts today because this has sort of been happening under the radar. But slowly, what we are seeing is a rebound in terms of Trump's odds. So these are betting market odds suggesting that now Trump actually has a slight lead over Kamala Harris heading into the elections, which are only about 4 weeks away. And bear in mind, later today, Bloomberg News editor-in-chief John Micklethwaite will be sitting down with former President Trump, Republican presidential candidate, at the Economic Club of Chicago later today. So that's something to watch out for. Should be a good conversation. But let's get back to our main geopolitical news from the region. The Washington Post is reporting Israeli Prime Minister Benjamin Netanyahu has agreed to limit his country's retaliation against Iran to military targets. Netanyahu has reportedly told the Biden administration he would not target Iran's oil infrastructure or nuclear installations in retaliation for its missile barrage on Israel earlier this month. This comes as Israeli military says 90 projectiles were fired from Lebanon only a day after Hezbollah drone strike killed 4 Israeli soldiers. The IDF says all threats aimed at the central region were intercepted. Meanwhile, Lebanon's health ministry said an Israeli airstrike in the remote district of Ihdan, well north of Beirut, killed 9 people on Monday. The Associated Press also says an airstrike hit an apartment building in the northern village of Zgharta, killing at least 21 people. For more on this, Bloomberg's Dan Williams joins us now from Jerusalem. Well, Dan, there has been a notable impact on markets. We're going to talk about that shortly with our energy correspondent in reaction to this Washington Post story suggesting that Israel's response to the Iran missile attack is going to be centered on military infrastructure as opposed to oil infrastructure. What do we know about the potential reprisal and what could a military infrastructure hit look like?
It's an excellent question. It's now been 2 weeks since that Iranian ballistic missile salvo against Israel, some 180 or 200 of those weapons being used against Israel on an unprecedented scale. But it's also 3 weeks ahead of the U.S. election. So it's a critical juncture, not just for Israel and Iran, but also for American political prospects. And I think all those factors are playing in here. Now, Israel has not formally agreed or openly agreed to limit its promised retaliation to military targets. It says it will heed and hear out its allies' concerns, but it will act according to its own interests. Now, all we know is speculation. Obviously, while the Israelis have been very public about their intentions, they've been keeping operational and tactical secrecy here. But presumably military targets could include the silos used to launch such ballistic missiles, to send a message to Iran, and indeed to prevent or limit further such salvos against Israel by Iran. It could also be members of the IRGC. This is the army within an army, or some have described it as a state within a state in Iran. It's really the core body that preserves the Iranian revolutionary impetus in that country, and is a power structure in its own right, and indeed has been guiding Iranian actions throughout the region, including against Israel.
And we speak about this, but again, as we were reporting yesterday, the conflict has been intensifying on the ground. We were talking a lot yesterday about the fact that those Hezbollah rockets were fired from the border and killed 4 IDF soldiers, many of them critically wounded. At the same time, the military siege in northern Gaza continues, and further airstrikes continue in Lebanon as well, one of the deadliest days for Lebanon yesterday too. So just talk us through about all of these different fronts that are going on at the same time, Dan.
I think it's beyond doubt that without a fully open front against Iran, Israel does have its hands full on those 2 fronts. The Gaza war is now over a year old. I think the Israelis had expected it would die down into an insurgency, and that's what we're seeing in much of the Gaza Strip. But there have been a resumption of some rocket strikes by Hamas, an indication Hamas is regrouping in the northern Gaza Strip. The Israelis have in recent days moved forces back in there, and Palestinians and some foreign agencies are complaining about new shortages of food and other aid. The Israelis are pushing back against that, but there's no doubt, I think, that they're really trying to find a new formula for ensuring that Hamas doesn't resurrect itself in what is the hub of former Hamas governments in the Gaza Strip. In Lebanon, over the past month, we've seen really full-on fighting between Israel and Hezbollah after Hezbollah had been spending the previous year attacking Israel, exchanging fire with Israel, but more standoff fire in solidarity with Hamas. So we have an Israeli ground push in southern Lebanon against Hezbollah emplacements. And as you noted, quite dogged, albeit limited in number, Hezbollah salvos, including against central Israel, including one drone attack that managed to penetrate into a training base of an infantry brigade, one of Israel's core infantry brigades in the north of the country, and hit a mess hall as soldiers were eating dinner, killing 4 soldiers and wounding something like 50 others. So Hezbollah, while I think there's no doubt, has been cut down in terms of losing its core leadership, in terms of losing many of its long-range weapons, is showing that it's still in the fight by sustaining daily attacks on northern cities like Haifa, even as far as the Tel Aviv area yesterday.
Yeah. Bloomberg's Dan Williams in Jerusalem. Thank you for the latest reporting. Well, we are keeping an eye on moves in oil after Washington Post report that Israel may avoid targeting Iran's crude infrastructure, as we were just speaking about with Dan. So for more on this, let's bring in Bloomberg's Mideast energy reporter, Anthony DePaola. So big moves today in oil. The complex is down 3%. I guess the question is, how much geopolitical risk premium was there priced in to begin with?
Yeah, good morning, Jumana. The oil price has been coming down over the last couple of sessions as we wait for an attack, and now we're getting these reports that it won't be on those oil installations, which is a really important factor in what the market has been looking for. We've seen kind of a leg up in geopolitical risk this time around as fighting intensified between Iran and Israel, and we had those direct attacks again. So we've been looking more like a $5 to $10 premium based on the geopolitical risk. Up until now, we'd seen swings of about $5 tops, and the market had been very slow to react to the geopolitical risk because it hadn't been impacting the supply. So now that we have that potential of bringing Iran more into the fight here, that's where the risk rises for an interruption of supplies, because Iran is a huge producer, and they also do sit right there on the Strait of Hormuz, which is the exit out of the Persian Gulf. So it's a very important trade
A couple
route.
of other data points caught my attention. OPEC Plus cut their oil demand growth estimates for the third month running, and they tend to be on the higher side anyway. But then also, crucially, China oil import data once again saw imports declining for a fifth straight month. So what does that tell you about the fundamentals here?
Yeah, so that tells us kind of what's going on in the underlying market, that there's weak demand going forward. As you said, OPEC has had some huge demand estimates, very optimistic, something like over 2 million barrels a day for this year, when a lot of the analysts were showing even earlier in the year slightly over 1 million, now a lot saying below 1 million barrels a day of demand. So that's a big change. They're also tweaking their estimates for 2025 because OPEC is supposed to bring some oil back starting in December, and that's going to increase the supply. That risks causing oversupply and some oil in storage next year. So that's why people are a little bit more bearish on those underlying fundamentals. And one thing that we should also mention is that markets, again, were a little bit unperplexed by the news coming out of China. They had this meeting on Saturday about some additional stimulus, which did talk about additional stimulus without that many details. So the market is really watching to see if that stimulus is going to impact kind of the retail market, where we get that fuel demand. Rising fuel demand in China causes rising crude demand, and you get more barrels flowing in there. Otherwise, China's got a huge refining complex which can export to the rest of Asia, thereby bringing down the margins in the rest of Asia. So we kind of need that piece to come back for traders and the market to be a little bit more confident about the future of oil prices.
Yeah. Anthony, we'll leave it there. Thank you so much for the overview. Anthony DePaula, Bloomberg's Middle East energy reporter. Well, still ahead, hear why Emirates NBD has shifted its stance from neutral to overweight on China as traders look for more fiscal policy support. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. China is said to have started enforcing a long-overlooked tax on overseas investment gains by the country's ultra-rich. Sources say some wealthy individuals in major Chinese cities have been told to conduct self-assessments, and others have been summoned by tax authorities for meetings to evaluate potential payments. The move comes with Beijing looking to expand its sources of revenue as land sales tumble and growth slows. For more on how markets in Asia are reacting to this news and more, let's get out to Avril Hong in Singapore. Just give us an overview of how markets have been digesting the latest announcements coming out of China, including today's.
Yeah, I think investors have been trying to make sense of the bits and pieces of stimulus efforts and reported efforts by Chinese authorities. We have the likes of Tyson reporting that they could raise $850 billion thereabouts via special bonds over 3 years to boost growth. And then, of course, there was a Bloomberg scoop about mega banks potentially as soon as this week cutting deposit rates. So it gives you a sense of the kind of sentiment on the ground there in terms of stimulus. But that seems to have underwhelmed investors, where the CSI 300 has erased some of yesterday's about 2% gains. The Hang Seng is extending losses. It looks like whatever's come through so far is just not enough to lift sentiment and appetite. More concrete measures may be needed. That being said, we are seeing pockets of positivity in other parts of the Asia Pacific, namely from Japan. Stocks there are leading gains in the region today, tracking what we saw on Wall Street, helped along by the overall weakness that we've been seeing of late on the Japanese currency, although it is firming up a little against the greenback at the moment. Jumana.
Avril, thank you so much. CSI, as you speak, is down about 0.5% today. So still a lot more volatility in those markets. Let's turn to U.S. markets now. The S&P 500 notched another record as investors look ahead to more U.S. bank earnings for further vindication of soft landing bets. Let's bring in Anita Krishna Gupta, Head of Equity Strategy at Emirates NBD CIO Office. Good to have you with us, Anita. Maybe let's just start with the S&P. Yet another record high earnings season. We're just getting into the middle of it now. What are you watching out for this season?
First of all, good morning, Jumana. And it's not all black and white. We've been looking for the last, I would say, 7 quarters more at risk rather than the positives. So let's look at the positives around U.S. earnings. We've got a 46th record high for the S&P 500 this year. You've got analyst expectations at 4.2% year-and-year earnings growth for Q3. But if you're looking at what CEOs are saying and what the Bloomberg report itself says, is that possibly the earnings growth for this quarter is going to be around possibly even 16%. So last quarter we surprised to the upside. The one before that we surprised to the upside. So anything between a 3 to 4% positive upside is great for equities. So let's keep looking at the positive, look at that earnings growth, look at the AI-driven productivity, look at what healthcare is doing. We've got all sectors positive year to date, and even yesterday, barring 2 sectors, everything was positive. So I'm a little optimistic going into year end.
Yeah. What about tech concentration? I was noting earlier on the show that NVIDIA once again is back at a record high. Remember, there was that little tumble with the stock over the course of the summer, but we fully recuperated those losses and more. Do you expect tech concentration to once again become a theme for this market?
Tech concentration never went away. We have currently got the Mag 7 stocks up 44% for this year. Barring Tesla, 6 of the 7 are positive. NVIDIA is up, I think, roughly about 170% this year. That adds to last year's gains. Now, what's driving up these stocks, whether it's NVIDIA or Meta or other semi-stocks, is the demand, the perceived demand for chips. The Blackwell chip demand is doing well for NVIDIA. Now, a lot depends on what happens on the earnings call. Now, for the last, again, repeating 7 quarters, it has not been disappointing. So I don't think it's going to be a disappointing quarter this year. Whatever outlook is given by the CEOs, whatever said in the calls post-earnings, that's going to be watched very carefully once again. Again, we are seeing, when we asked, what are we watching? We are watching elections. U.S. elections are very important in terms of all kinds of policy that would come out. So that now remains for us the next critical event post-earnings in October.
Anita, I noticed in your latest report, you've said that you've moved your overweight stance from India to China within the emerging market allocation. I'm assuming this is a recent decision that you took on back of some of those China stimulus measures. So just talk me through what upside you see there.
Okay, so what we did for China, we've been neutral, and we decided in early September to go overweight China on the back of the fact that China still has very low valuations, 12 times price to earnings, compared to the rest of the world, compared to the median level of PE for China the last 5 years. So when we are seeing these measures come in, and so far we've seen a lot of measures to support real estate market, to support liquidity in banks, to support increased trading. And of course, what we expect is that it's not going to be a straight line up, but we're going to see more fiscal measures come in. So at this point, weighing the pros and the cons and considering that India is a little expensive, we don't take away a strategic overweight long on India. All we say is tactically we think for the next 3 months, it's time to be invested in China.
I see also in your notes that you are neutral on Japan from here. So why the hesitancy to get involved in the Nikkei? Is it just because there's been so much volatility in that market as of late and it's highly dependent on the direction of dollar-yen, or are there other reasons?
We do our overweights and underweights relative to each other within the developed and emerging market space. So within the developed market space, we have been overweight the US from the beginning of the year, and I think that's been justified. We were overweight Japan in the first quarter, and that worked well. And then we went neutral. We think that Japan has a lot of upside. It's going to continue to go up steadily. However, the US wins out in terms of sheer performance. Japan market has been more choppy. We saw the early August sell-off. Recently, we are a little more heartened by the fact that the Bank of Japan is getting a little bit dovish. So we are neutral. That means we are fully invested in Japan as per market weight.
To what extent do you think the Fed's upcoming rate-cutting cycle is going to determine the direction of global equities from here? How much is that going to be the catalyst for further equity market performance, not just in the U.S., but around the world?
It's a huge catalyst, not only in the US, but rest of the world. Starting with the US, the 50 basis point cut, the last meeting was very positive for equity performance. It was received well. It's great for domestic stocks, especially. It's great for mid-cap companies because they do pay higher interest rates. Overall, it's been positive sentiment for the rest of the U.S. market too. It's for the rest of the world, it means it's a bit of a weaker dollar. Now, that really hasn't played out that much. We did see a little bit of weakening of the dollar, and that's positive for inflows into emerging markets. At the same time, we've had the China stimulus. So overall, it's been two positive effects for the global stock market, a combination of rates coming down not only in the US, but also in the Eurozone, in the UK. And again, we are looking at countries like India, which has held steady at 6.5%. We are looking at China, which has been a little bit steady again on the yield front. So overall, US rate cuts will continue to be positive.
Yeah. Anita, always a pleasure to chat to you. Thank you so much for joining our show today. Anita Krishna Gupta, CIO, Office Head of Equity Strategy at Emirates NBD. And coming up, Senegal's former president says he hopes the next U.S. president will be more open to the needs of Africa. That exclusive conversation next. This is Bloomberg.
We are looking what will happen in the United States. As you know, the position of the president will depend on the relation between Africa and U.S. Of course, we are not interfering on the election. We are just waiting what is the choice of the American people. But Africa needs a new international cooperation. We need a new multilateralism, more open and more focused on more justice, even on climate justice. We need also the reform of the international architecture, financial architecture. We need to reform the IMF, the World Bank, to get more access for developing countries. This is absolutely fundamental. So we hope the next president of the United States will be more open on that, because it is their historical role to work together with other countries and to avoid the fragmentation between Western and the BRICS and the global South. We need more comprehensive world today and more inclusivity.
That was Senegal's former president, Macky Sall, speaking to Bloomberg's Jennifer Zabadaja at the Future Resilience Forum in London. And the upcoming edition of Africa Amplified will take a look at what the next occupant of the White House could mean for the continent. So join us for that first on November. Good morning. This is Horizons Middle East and Africa, our top stories this morning. Oil slumping after a report that Israel will avoid targeting Iran's crude infrastructure and instead focus on the military. It's easing concerns of a major supply disruption. China said to be looking to raise around $850 billion in special bonds and even taxing the ultra-rich to raise funds to boost the economy. But investors remain unimpressed. Former President of Senegal, Macky Sall, tells Bloomberg exclusively he hopes the next U.S. president will be more open to the needs of Africa. Plus, the state of UK politics and the economy. We'll hear from our exclusive interview with Prime Minister Keir Starmer, followed by a conversation with former Chancellor Nadhim Zahawi. Well, good morning again, everybody. It has just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai, and another positive session for the S&P yesterday, 46th record high for the year as we really get into the swing of earnings season. Today, we're going to be watching out for results from the likes of Goldman Sachs, Citi, and Bank of America. So that's going to be key to direction from here. And of course, that follows on from very strong results from JP Morgan, Wells Fargo last Friday. Tech also in focus. Nvidia once again making a record high. That stock seems to be unstoppable. Today, you can see, though, on the screen, we've got these futures leaning slightly towards the green, up about 8 basis points for S&P, marginally so for NASDAQ, not doing a lot this morning. But of course, the general direction has been quite positive. A lot of focus, though, overnight on what's been happening in the oil complex. We have Brent trading at around the $75 handle now, down 3%. A couple of factors that we've spoken about on the show, namely that Washington Post report suggesting that Israel will only strike military infrastructure in Iran as opposed to oil infrastructure. So the market here is breathing a sigh of relief, in addition to some of those weaker demand signals that continue to come through from China and the fact that OPEC Plus has cut their oil demand growth outlook going into next year. The handover from Asia Pacific today, though, positive, up 0.3%. And very quickly, I just want to draw your attention to something that we've been monitoring quite closely as we head into the U.S. elections. Look at this. Per the latest betting odds, Trump has actually overtaken Harris in the last couple of weeks. You've seen a bit of a spike. You can see over the course of October, Trump's odds have been steadily climbing again. So bear that in mind as we head into the all-important election date. But on that note, Bloomberg News editor-in-chief John Micklethwaite will be sitting down with Donald Trump later this afternoon at the Economic Club of Chicago. So stay tuned for some of the headlines that will come through from that. Now, over in the UK, the Prime Minister, Keir Starmer, has rejected the suggestion his government was considering raising capital gains tax to as high as 39%. He spoke exclusively with Bloomberg as he tries to calm investor jitters ahead of the budget at the end of the month.
All of the discussion today has not actually been about tax. It's been about planning. It's been about the regulatory environment. It's been about getting infrastructure moving much more quickly and the sort of apparatus of government working to that common end. That's the real discussion that's going on here. That's the real focus. And actually, contrary to perhaps what people might think, tax is not the first thing that businesses and investors are raising with me. The first thing they're raising with me is it really your number one mission? Is it going to be stable and strategic and for the long term, to which the answer is yes? And are you prepared to do the tough things on execution and the deliverables, which is about, you know, the length of time it takes from investment decision to actually seeing a project materialise? That's where I think we've been able to do a lot of reassurance that, yes, we understand that, and we're determined to do the follow-through on growth that is desperately needed for investors, for our country, and for the jobs of the future.
Forgive me, Prime Minister, but I think a lot of people, they may not be talking about it to you, but a lot of people are worried in this sort of vacuum that we've had, quite a long wait for the budget. There's quite a lot of what might be just crazy speculation around where capital gains tax might go, for example. So something like a 39% rate. Can you reassure people that whatever the change is, it won't be anything that significant?
Well, quite a lot of speculation is getting pretty wide of the mark. But
so you say that 39 is wide of the mark?
It's getting to the area which is wide of the mark. But I'm not going to fuel the speculation because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget.
UK Prime Minister Keir Starmer speaking exclusively with Bloomberg News' Stephanie Flanders. Well, let's bring in Nadhim Zahawi, former UK Chancellor of the Exchequer and former UK Conservative Party Chairman, who joins us in Dubai. It's great to have you here with us.
Good morning. It's great to be with you.
You heard some of the comments now that the Prime Minister gave to my colleague in London. In another part of the interview, he said, we must deal with the inherited fiscal black hole in the budget. Rachel Reeves has put that number at £22 billion.
It's not true.
Is it fair that is it fair that the UK public have to pay the price of decisions taken by the Tory government?
Well, first of all, it's not true because actually, as you know, I was Chancellor of the Exchequer, and then, of course, Jeremy Hunt, my team there, they know, which is why they actually, when asked by our own media to specify what that 22 billion is, the Treasury didn't. And I think that was part of sort of Labour's political manoeuvring to try and create some headroom to raise taxes. I think they're making a mistake, by the way. I think she had more headroom because gilts were moving in the right direction, but now they're not, because actually most of what they had in their manifesto is unravelling. So the VAT on schools looks like it's not going to raise much money. What they're doing on non-doms, and by the way, I think we made a mistake on this. Jeremy Hunt made a mistake on this, and you see it here and in Abu Dhabi. You know, Abu Dhabi is becoming the capital of capital, not just financial capital, but human capital. The inflow of talent from Europe, from across, and from the UK, sadly, is a real problem. And I think it's something that the Chancellor needs to be really aware of. My old team, I know, are very talented in the Treasury. They'll be looking at all this. And if it's not going to bring any money in, then we should reverse it or pause it before we do more damage to the economy.
It just seems as though higher taxes is going to be the way forward now for the UK economy.
That's the problem, right? The problem is you look at the speculation. Yesterday, there was speculation on our media that she was talking about capital gains tax going up. Then they made a mistake. They thought it was going to be corporation tax going up. All this uncertainty, what does that say to the investors? You know, when you look at what Sultan Al Jaber is doing here and around the world, by the way, investment, the big investment in Germany that the UAE has just made, making it probably one of the top 5 petrochemicals producers in the world. You have to ask yourself, in England, we're now a mid-market economy after leaving Europe. I think is a positive thing if you're agile, if you begin, and I liked what Keir Starmer said about the regulatory framework. I had an initiative that Boris backed to say get the regulators around the table and call it Regulators for Growth. What are you going to do as a regulator to cut red tape, to cut away some of the barriers for investment? Because a lot of sovereign wealth funds say, yes, it's the stability of the economy and legislation, but regulation is what hinders investment. And I liked what he talked about on there. My fear is we're losing talent, not just the ultra-high net worth, the billionaires and the non-doms, but people who are talented, you know, 34-year-olds, 35-year-olds who are coming to Dubai. You look at North Star, this incredible investment conference here. It's extraordinary. It's about 5, 6, you know, aircraft hangars worth of ideas, innovation, pre-seed, seed. I think something like 40 to 60 unicorns.
We've spent a lot of time talking about that over here. Let me also just ask you, the leadership contest is coming up. You've thrown your support behind Robert Jenrick, but he is also former immigration minister and is espousing very hard anti-immigration policies, is calling to leave the ECHR. What do you make of the view that the Conservative Party is lurching towards the right to gain back some of those voters who went to the Reform Party at these elections?
What Robert Jenrick has done is actually studied what happened, the mistakes we made, which he put his hand up and talks about as a Conservative government over the past 14 years. What he's talking about is getting immigration right. So now that we've left the EU, controlling our borders is only sensible, if you think about it, right? What do we want to do? We want to attract the best and the brightest, so have policies like low taxation to bring talent in, but stop what I call the low skill people who are effectively putting much more pressure on the NHS, on schools, on all the other services. So you want high skill because you want GDP per capita, not just GDP growth. And I think for far too long, and I put my hand up, the Conservative government focused on just GDP growth, as did the Treasury, rather than GDP per capita, which is about attracting talent. And what Robert's talking about is saying, look, let's stop the illegal trade in human migration, which is coming across in these small boats, putting people's lives at risk. Let's actually have a debate in Parliament and a vote to cap the level of migration. Last year, we got 740,000 people. Much of that is low-skill labour that puts more pressure on the Treasury and on public services. So I think actually he has a very sensible set of policies, 5 policies that he will implement, and I think actually he'll give Keir Starmer a real run for his money.
Well, we'll see how it all plays out. Look, we are in the region right now. Let me just ask you, would you be supportive right now of a ceasefire in both Lebanon and Gaza?
So the British government, and David Lammy, I think, is right to be... he's travelled the region and he's talking to our allies in the US and elsewhere. We need to get to a place where there is a ceasefire. We need the hostages out of Gaza. That's really, really important. And actually, we need to make sure that ultimately, there is a Palestinian state. The Palestinian people deserve much better than what they're getting today, what they've had for decades under, whether it's the administration in the West Bank under Abu Mazen or the terrorists in Hamas. The Palestinian people deserve a decent government. They deserve a state. So I think in many ways what I've been calling for is the return of hostages and, of course, at the right moment, once you dismantle these terrorist groups, to have a Palestinian state that actually is in Israel's interest to lead and to help make happen, because ultimately we're never going to get to peace and prosperity, which is what you want. Look at this. Look around you. 200 nationalities live in this great country in peace. You're never going to get here unless we get to a place where there's a viable Palestinian state living next door to Israel.
Has the international community done enough to lead to that outcome? There hasn't been one G7 or G20 meeting about the situation in the Middle East. Where is the international community?
Clearly, look, David Lammy and before him, David Cameron tried very hard, as Tony Blinken and the team in the US, as Sheikh Abdullah bin Zayed here, who has more experience, more knowledge of what needs to happen. We need to listen to our allies, would be my advice to my colleagues in London and in Washington. When you have countries like the UAE who are so heavily invested in trying to resolve the situation. Look at the aid package that the UAE has put into Gaza. The most effective. They don't just talk the talk, they walk the walk. We need to listen to our allies here to be able to have the day after fix for the situation. I think it's no good just putting a plaster over what will just unravel very quickly. The Palestinians deserve a better administration. Once you do that, that has to be the first step. We all have to agree they need a non-corrupt, better administration. Once you get that, the international community and the regional powers can coalesce around that. But that's not happening.
Yeah. Final question, because you are here in UAE and we've spoken about it. Talk to me about the ongoing bid for Telegraph. Do you think you still have a chance?
I can't talk to you about that because
but do you think
it is clearly... I would be honoured to be involved with a paper like the Telegraph. I've always said this. I said it when I was asked very early on in the process, would I consider chairing the Daily Telegraph? It is a great newspaper. It delivers a great product. Has, I think, over 1 million subscribers in the UK. Has a huge potential for growth in the US and elsewhere. You look at what the New York Times has done for democratic-thinking Americans. Imagine what you can do for Republican-thinking Americans with a product that is very much American from the US, but Telegraph.
So David Ifrin would be a good owner for it then?
I think he'd be a great owner for it.
Okay, that's a good place to leave it. Thank you so much for joining us. Really good to chat to you. Nadhim Zahawi, former UK Chancellor and former UK Conservative Party Chairman. Thank you. Well, also coming up, a Turkish company wins a $3 billion contract to build a railway in Uganda. More on Turkey's growing influence in Africa next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. A Turkish company has signed a $3 billion deal to build a railway line in Uganda. Uganda decided to award the contract to Yapi Merkezi after it previously struggled to find financing following the withdrawal of a Chinese company. For more on this, Bloomberg's Adira Ganga joins us now from Kigali. So tell us more about this project and what the railroad was attempting to do and why a Turkish company was actually successful in the end.
Jumana, so this project is supposed to connect the border town of Malaba to the capital city of Kampala, and construction of the 272 kilometers line is expected to commence in November and completed in a period of 4 years. And upon completion, it's supposed to transport at least 25 million tons of cargo every single year. The model that they're going to use is EPC, where they're going to be in charge of the engineering, procurement, and construction. And at $3 billion, this makes it one of the largest projects that a Turkish firm has ever endeavored or signed abroad. Also, Uganda will be seeking financing after Chinese financiers pulled out, and they're looking at syndicated loans with Citibank being the lead arranger. They'll be looking for money from development agencies and also export credit agencies. And the reason why the Chinese investors pulled out is because they were not sure that the Kenyans were going to complete the SGR from the Mombasa port to the Malaba border concurrently with the Ugandan project. And that's why those talks stalled, and this contract was now awarded to the Turkish firm.
What is the expected impact of the project? And it's interesting to hear that it's actually Turkey that are looking to grow their influence on the continent. What does that tell us?
Absolutely, Jumana. So there are several advantages to this project. One, it will cut the cost of transporting goods from the port of Mombasa to Kampala by half. Currently, it takes about $3,500 to transport one container. That cost is expected to come down, and it will affect also the cost of goods in a positive way for the consumers. It's also expected to promote regional connectivity in East Africa. But in terms of influence, it's good for Turkey. China is beginning to pull back on mega infrastructural projects, and this means that a window of opportunity is opening up for new players. Turkey has already built a $3.1 billion standard gauge railway in Tanzania, and so success in Uganda would go a long way in putting them on the map in Africa.
Bloomberg's Adira Ganga, thank you so much for bringing us the latest on that railroad project. And now for a look at some of the other stories we're following today. Turkey is close to an agreement with the World Bank to finance a $4 billion railway project across the Bosphorus Strait as well. The Transport and Infrastructure Minister told Bloomberg the deal is close to finalized, with technical details still being negotiated. The railway would cross the Yavuz Sultan Selim suspension bridge, one of the longest and widest of its kind in the world. It's being promoted as part of Turkey's development road, the project linking Asia and Europe. And coming up, Citigroup, Goldman Sachs and Bank of America report earnings later today. More on what to expect next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Citigroup, Goldman Sachs and Bank of America are likely to flag rising revenue pressures in earnings reports later today as the Wall Street giants start to reckon with Federal Reserve rate cuts. So for more on this, Bloomberg's Charlie Wells joins us now. Charlie, let's rewind back to Friday when we were anticipating those JP Morgan and Wells Fargo results, and they actually came in much stronger than what the analyst community had been penciling in. Is this a good omen for the rest of the banks?
It's either a good omen or a lot of pressure, because they certainly beat expectations and were rewarded for it by the market. But if you look at the three big ones that are reporting today, we've got Goldman, Citigroup, and Bank of America. If you rewind back to September during conference season, a lot of those executives tried to temper expectations because bank stocks have been doing actually incredibly well. So we heard David Solomon from Goldman talking about how we needed to temper expectations on trading. If you think about Bank of America, Brian Moynihan was talking last month about investment banking and how the transaction mix for them just wasn't right. And then with Citigroup, you got to think about how they've been going through some of the biggest changes in that bank in decades. So we'll see some of those changes potentially trickling out in earnings, and also some pressure that CFO Mark Mason talked about on cards.
And, well, this is what I was going to ask you, right? We're heading into a cutting cycle from the Fed. And to what extent is that actually going to serve to provide some headwinds to the banks? And how likely is that, are we to hear about the impact rate cuts are going to have on overall profit margins and the bottom line?
Well, Jumana, that 50 basis point cut last month is what makes this earnings season so interesting, because we are entering a new era for these banks, a new kind of set of dynamics where it's potentially more difficult for these banks to make money from net interest income. So, you know, analysts are expecting slight declines at a number of these banks. I think they may be frustrated because last Friday, JP Morgan actually beat on expectations there. But going into today, we're actually looking to see that net interest income earnings be more in line with kind of what Wells Fargo saw, so a dip there. And that really, though, is what is going to make this earnings season and others really interesting.
Well, you and I were just speaking offline about what a massive run-up we've seen in these tech stocks. I wonder to what extent the results from the banks is going to help determine market sentiment, broader market sentiment from here.
Yeah, I mean, no pressure on these three stocks today, but, you know, the KBW Bank Index has actually been outperforming the S&P 500, so that's adding a lot of enthusiasm and momentum. Also pressure here. And look, the two banks that reported on Friday were heavily rewarded by the market for beating expectations. Puts a little bit of pressure on these other banks reporting today. So certainly adding a level of excitement that we're seeing in the space that maybe we haven't seen in previous quarters, or at least for a while.
Yeah. Charlie, thank you so much as ever for the look ahead to what to expect out of these three banks that are reporting later today. This, of course, as the S&P makes another record high for the year. Well, a quick look at some of the key movers today. Oil is in focus. We're dipping around 3% in trade. As you can see, $75 is where Brent is sitting right now on this Washington Post story that Israel are unlikely to hit oil infrastructure. So that is giving that market a bit of a breather, as you can see on the screen up front. But that was it for our show today, Horizons Middle East and Africa. I'm Jemana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.